If you've watched the equity markets here in India of late, you will have noticed that they've slipped from the recent high of about 18,300 for the Nifty 50, and in fact the broader markets are taking quite a bit of a battering as well. If you've spoken to anybody or if you've listened to experts on this channel as well, they've all pointed to the fact that there is the rollback of easy monetary policy in the US. The Federal Reserve is tightening. There is a rollback of quantitative easing. A tapering is taking place. Now, if you're a little confused with all of this and wondering how something in the US is affecting us here in India, we've got you covered. We're going to break things down so that you can understand it. Joining me to speak about this is Kirtan.shah, Certified Financial Planner and Founder and Chief Executive Officer of Credence Wealth Advisors. Thank you so much, Kirtan, for joining in. I'm going to start by asking about the most basic thing, which is the context. What is this quantitative easing? How does it work? Why did the Fed start it? And what was the context in which it was started? And I believe that this all goes back to around the pandemic time when this got a further push from what it was in previous years.
Hi, Alex. Thank you so much for having me on the show. So, Alex, like you rightly pointed out, it goes back to when the pandemic started. So when the pandemic started, of course, there are 2-3 things that happened, and all of us can relate to it. Where businesses suffered huge losses. People were laid off, and also at the same time, because people were laid off and businesses were not doing well, there was not a lot of demand for goods and services, right? And you also term that as low inflation in the general context. So whenever you have such a thing happening, and it typically happens in all crises, but if we stick to pandemic, it happened in pandemic again, right? So whenever something like this happens, typically you would see that the immediate step that the government will take or the central banks will take of any country is trying to do 2 things: reduce interest rates and pump in a lot of liquidity in the market. Now, let me break this down a little more. Why would you decrease interest rates? You would decrease interest rates because you would feel that if interest rates come down, typically what will happen is that loans will become slightly cheaper. And because loans will become cheaper, you will be able to fuel a lot of demand in the market. Like, let's say if interest rate goes down, it might be a slight incentive for you to go ahead and take a loan and buy a house, go ahead and take a loan and buy a car or a bike, or even go ahead and take a loan and buy a mobile phone or a laptop, right? So typically when there is a crisis situation and demand typically falls, which affects the larger economy, central banks would go ahead and try reduce interest rates, for which demand is expected to go up in the market, right? The second thing that typically central banks do, which is termed as quantitative easing, is buying back bonds. Now, how does this work? Look, as a bank, suppose if you've raised 100 rupees from the market, right, and your business is to lend this 100 rupees to somebody else as loan and make the differential as profits. Long story short, the 100 rupees that you borrowed from the market, you cannot lend that 100 rupees to the market because of various reasons like an SLR, CRR, or various other things that the RBI has put in place, right? So typically, to manage the amount of money available with the banks, what RBI or any other federal bank typically does is, at every instance, issues bonds, right? So what happens is, the Fed or the RBI will issue bonds in which the bank will invest, and the bank will receive the bond and the RBI or the Fed will receive the money. So every time this new bond is issued in the market, banks invest in it and banks will have less liquidity available. Now, typically in a situation where you are trying to infuse liquidity in the market, you do the reverse. So you go back to the bank and tell the bank that the bond that I gave you some while back, I want to purchase it, right? So the Fed or RBI will purchase that bonds back and give banks liquidity. Now, as soon as banks have liquidity, again, the thought process is that if the banks have a lot of money, interest rates will fall or the banks will try and lend it as much as possible. So in a nutshell, what I'm trying to say is, whenever there is a crisis situation, demand falls. To up the demand, either central banks will reduce interest rates or try and push in a lot of liquidity, right? This is exactly what happened back in the US also during pandemic. Interest rates were got down to zero, right? Almost close to zero. And a lot of liquidity was fueled in the system, right? Now look at it this way, Alex. When today, while we are talking of 18, 24 months later, we've seen companies recover, jobs coming back, job markets coming back, right? And demand also to a greater extent has come back, right? Because of which it is leading to a lot of inflation
Yeah.
in the market. Now, if everything is in place, and sorry for this long answer,
Right.
if everything is in place, right, why do you still need to be incentivized with a lot of liquidity and lower rates? Is exactly where you do exactly the opposite as a central bank. You try and increase rates, which you decreased originally. And now you try and tell the banks that I'm going to stop purchasing the bonds from you and giving you liquidity. This, in a nutshell, is the quantitative
Yeah.
easing that everybody is talking about, Alex.
Absolutely. And I think you've explained it very well in that you've talked about the reason why quantitative easing needs to take place. And there are also implications, Kirtan, in the way that assets globally get bought because the system is flush with liquidity and the US financial institutions are those that invest in markets around the world. You will have a lot of inflows into markets like ours, right? Emerging markets get a lot of money pumped in. And I think you've also pointed out that foreign institutional buying in our market, in our equity market, had also risen tremendously during the time of the pandemic. And all of that is rolling back. So how does one understand where things stand right now? Because we're still talking about the possibility of interest rates going up in March. You're talking about the bond buying starting to stop. And I know that is a bit of a complicated sentence, but quantitative easing going to get rolled back starting March. We're not yet started that. So how does one understand what is going to happen from this point on? Does the route extend?
So, Alex, look at it in this context. When so much of liquidity was pumped in the market, let's talk about US. Individuals were given unemployment benefits. They had a lot of money. They didn't know where to spend because there was hardly anything operating. Corporates could borrow at almost close to zero interest rate, which was prevailing then. Banks were pushed with a lot of liquidity where those bonds were bought back. Now, all of these guys in the US had so much of money and interest rates were close to zero. What do you do when interest rates are close to zero? You will not invest in fixed income because you will hardly make any returns, which is why this money got pumped in gold and equity globally, right? So if I have to put this in context, over the last 18 to 24 months, if I'm not wrong, FIIs, because fixed income had no real investment opportunity, pumped in close to 2 lakh crore worth of investments in the Indian equities market. That's the kind of money that came in because globally interest rates were close to zero. Now what is happening is, Alex, is very simple, where you are seeing inflation go up, right? And as a central bank, the biggest challenge always for you is to make sure that inflation stays under control. Now, US wants their inflation to be around 2%. Inflation in the US is around 6-7%, which is huge. To control this, what US is trying to do is say that I'm going to increase interest rates and I'm going to pull back the liquidity that I was giving you. Now, typically what happens is, Alex, when interest rates start moving up, right, 2-3 things happen. First, fixed income becomes easier for you. From a close to zero interest rate that you had, for which you didn't invest in fixed income, now if interest rate goes up, you would want to invest more money in fixed income than take a lot of other funds, right? Also, when interest rate goes up, the demand might fall is because loans might become expensive, right? Another reason why equity typically takes a brunt, right? And also what happens is that because interest rates are going to go up, right? The easy liquidity which was available, right? Because the US keep pumping a lot of money is also going to go away, right? So a lot of these things put together is what markets are currently experiencing, because of which typically you would see a knee-jerk reaction when markets are falling, assuming that a lot of this money that came back over the last 18-24 months is going to go back. And that's exactly what you are seeing. FIIs have been rigorously selling over the last 2-3 months. Now, to come to the point, Alex, if I may, right? How can this affect markets? Look, long story short, if I have to tell you this, if you go back to history and look at situations where interest rates have gone up and how a market's reacted. Theoretically, when interest rates go up, markets would react negatively for the concepts or reasons that I explained to you. But if you look at 2002 to 2006-8 kind of a
Right.
period, you will realize that that was a time where interest rates actually went up, right? But markets also went up significantly. So the answer to this question of where the market is supposed to move is completely dependent on earnings. Historically, if you look at it, in a rising interest rate also, if the companies have been able to increase and project and achieve higher earning multiples and numbers, then the markets will sustain. But if in an increasing interest rate situation, if earnings are not maintained or sustained, markets will typically react on the south side, Alex.
That makes sense. There's also a correlation that people draw with bond yields and tech stocks, right? In that how they've when bond yields are rising in the US, the first thing to start showing an effect on the downside is the Nasdaq, because it has a heavy weightage of tech stocks. I'm just trying to understand from our perspective here in India, and perhaps we can move to the India context now, Kirtan, is that here too you're seeing bond yields rise, right? Because you have inflation that has persistently remained high. You have easy monetary policy here in India as well, and that is expected to roll back at some stage. I think people are building in the possibility of interest rate hikes by the Reserve Bank of India in this year as well. So, how does one position themselves in this context? Rising interest rates, rising bond yields on the one hand, and the equity markets in a bit of a state of flux on account of the kind of returns that they've had over the last couple of years. So perhaps valuations trying to catch up with actual earnings, and maybe also waiting for the dust to settle on the global stage.
I think, Alex, my one line answer to this question is that all of us have got spoiled for the kind of returns that we've made over the last 18-24 months. And this is the time where we reduce our expectations in equity for the next 1 or 2 years. Going back to your initial point around why Nasdaq fell more and why IT stocks are under pressure. Typically what happens is, Alex, growth stocks, which are the IT kind of stocks, they project a 5-year, 10-year, 15-year, 20-year earning. I don't want to name IPOs, but you've seen tech IPOs that recently have got funded, how they were projecting a 20-25-year growth story. Now, typically when you do a 20-25-year growth story, right, you typically do something called as discounted cash flow method. Too technical, but to tell you that you are trying to project future cash flows at a particular rate. Lower the rate is, higher is the equity valuation. Now, typically what happens is when you increase that rate, and because you projected for 20-25 years, your equity valuation falls. And which is why you are seeing what is happening to all the recently listed IPOs, tech stock in India and Nasdaq and other tech stocks globally. Now, this is a very common phenomenon. But to come back to your question, Alex, I think there are three things in my mind that we'll have to keep, right? The first thing is, let's not project what happened over the last 18-24 months as equity returns that we will be able to make in this year and the next year. I think we will have to soften our expectation on equities. Also, while bond yields go up, you will typically see mark-to-market losses on the medium and the longer end of the curve. So try and keep your average maturity while you're trying to invest in fixed income through mutual funds also lower. That will help. And I think in such a situation, you would typically see gold doing well. So try and have some allocation to gold because that probably can act as an hedge, Alex.
Okay, that makes sense. But I also want to ask you a couple of things. On the fixed income side, broadly, at least for incremental investments, Kirtan, would you say that it makes sense to stay on the shorter end of the spectrum, considering you could see bond yields going up already today? I think the 10-year bond yield has hit 6.75%, if I'm not mistaken.
So, Alex, typically this is a common phenomenon where you will see if interest rates and yields go up, you will see that the value of your bond will fall, right? So going by theory, of course, if interest rates are going to go up, and which is the broader expectation, you will typically have the longer end of the curve and the medium end of the curve react slightly more than the shorter end of the curve. And this is a common phenomenon that typically happens. So there are two ways of looking at it, Alex. if you want to today invest, right, invest in the medium or the longer end of the curve only if you have a 5-year investment horizon. If you don't have a 5-year investment horizon, I would suggest you stay at the shorter end of the curve. One. Second, this is slightly contra, and you would typically not seen a lot of us come to television and talk about it. But I think credit will do very well, in my opinion, in this period. So if you have anything less than a 5-year kind of an investment horizon of 2 to 3 year, I think credit, AA plus, AA minus kind of product or kind of a portfolio will do very well, in my opinion, risk reward basis. And if you have a 5-year and upwards of investment horizon, you can slightly be on the medium to longer side of the curve on the bond side, Alex.
Absolutely. Well, that sums it up, Kirtan. We've spoken about everything. I'm tempted to ask you about other risk assets, about crypto, for example, but I will save that for another day. It's been an absolute pleasure speaking with you.
Thank you so much for having me.